Welcome to Metal Market News. I'm Professor Harry. As always, I'm here with you as an independent analyst to break down what's really happening beneath the surface of the precious metals market, cutting through the noise and focusing on the data, the structure, and the psychology that drives price action. And today's discussion is particularly important because what we are seeing is not just volatility, but a developing structural story that many investors are either missing or misinterpreting. And when we begin by looking at the core idea presented here, the relationship between price and market balance, it becomes clear that the silver market operates in a self-correcting mechanism where price is not random, but rather the key variable that ensures equilibrium between supply and demand. So when prices rise, it naturally incentivizes holders of silver, whether they are retail investors, institutions, or even scrap suppliers, to sell into strength, capturing higher prices and increasing available supply. Which is why on the surface the market always appears balanced. But this balance is deceptive because it is not a static equilibrium. It is dynamic and heavily dependent on price elasticity. And the analysts point that a growing structural deficit will require higher prices is fundamentally sound. Because if demand continues to outpace supply, the only lever the market has left is price. And I agree with this interpretation. But I would go further by emphasizing that this is not just a linear relationship, it is exponential in nature once certain thresholds are crossed, meaning that small deficits can be absorbed quietly. But large and persistent deficits tend to result in sharp, sometimes violent price revaluations rather than gradual increases. And this is where most investors underestimate the potential of silver because they assume a smooth trajectory rather than a step function repricing. And when we transition into the broader market commentary about high-quality companies dropping 30% while gold turns volatile, this is where the narrative becomes even more interesting. Because what we are witnessing is not isolated weakness, but a cross-asset shift in sentiment. And historically, when both risk assets and safe haven assets begin to behave erratically at the same time, it often signals a transition phase in the market, not a conclusion, and I strongly align with the idea that this reflects a deeper sentiment shift rather than fundamental deterioration. Because fundamentals, especially in the case of gold, remain largely unchanged. And this brings us to the role of forced selling, particularly by sovereign entities like Russia and Turkey, which introduces a layer of distortion into the market that is often misunderstood by retail participants. Because when countries are forced to liquidate assets not out of choice but necessity, the resulting price action does not reflect true value but rather liquidity stress. And this distinction is critical because it separates temporary price weakness from long-term valuation trends. And when we compare this situation to historical events like the UK's gold sales under Gordon Brown, often referred to as the brown bottom, we see a clear pattern where forced selling tends to occur at or near major lows, not because sellers are irrational, but because they are constrained. And this is where I would slightly expand on the original analysis by noting that markets often front-run the end of such selling, meaning prices can begin to recover even before the selling fully stops, as forward-looking participants anticipate the shift. So in essence, what we are seeing is a market temporarily overwhelmed by liquidity-driven supply, but structurally supported by macroeconomic forces such as debt expansion, currency debasement, and geopolitical fragmentation. And this combination creates a highly asymmetric setup, where downside is limited by fundamentals, while upside remains open-ended once the distortion's clear, which is why despite the current volatility, the long-term outlook remains constructive. And in my view, the key takeaway here is not to focus on short-term price movements, but to understand the underlying drivers. Because those are what ultimately dictate where the market is headed. As we continue deeper into this analysis, the discussion around specific companies like Pop Mart International and Tencent Music Entertainment provides an important contrast between structural and cyclical weaknesses. Because while precious metals are influenced by macroeconomic forces, and long-term supply-demand dynamics, individual equities often react to much more immediate factors such as consumer trends, competition, and transparency. And in the case of Pop Mart International, the decline appears to be driven by the perception that its products may be more of a short-term fad rather than a sustainable business model, which is a classic issue in consumer-driven industries where novelty plays a significant role in demand. And I agree with this assessment to an extent. But I would also highlight that markets tend to overreact to the idea of a fad because they struggle to quantify longevity in such business models. And while it is true that many consumer products experience rapid cycles of popularity and decline, companies that successfully innovate and adapt can extend these cycles significantly. So the real question is not whether Pop Mart's current products are a fad, but whether the company has the creative and operational capability to continuously generate new demand. And this is where investor confidence becomes crucial. Because once the narrative shifts from growth to uncertainty, valuations compress Arabic Bay, Arabic Scene, Arabic Rod, Arabic Teen, Arabic Tetmer Buddha, regardless of actual performance. And this ties directly into the broader theme of sentiment-driven market behavior that we discussed earlier. And when we look at Tencent Music Entertainment, the situation is somewhat different but equally instructive. Because here the issue is not necessarily demand for the product, but rather competition and a reduction in transparency. And markets are, o tanto, sensitive to changes in disclosure, because information asymmetry increases perceived risk. And when a company chooses to provide less frequent or less detailed data, investors often interpret this as a red flag, even if the underlying business remains stable. And I strongly agree with the point that reduced transparency can have a disproportionate impact on share price because it undermines trust. And in financial markets, trust is as important as performance. And this is an area where I would emphasize that management decisions regarding communication can be just as influential as operational results because they shape the narrative that investors use to value the company. And when we step back and connect these equity-specific examples to the broader discussion of gold and silver, we begin to see a pattern where narrative shifts play a central role across all asset classes, whether it is the perception of a product being a fad, concerns about competition, or fears of forced selling in precious metals. And this reinforces the idea that markets are not purely driven by fundamentals, but by the interpretation of those fundamentals, which is why volatility often increases during periods of narrative transition. And this brings us to the gold price action described, where a strong upward trend was followed by a sharp spike and subsequent volatility. And while some may interpret this as a trend reversal, the longer-term perspective suggests otherwise, because when viewed over an extended time frame, these movements appear as minor fluctuations within a broader upward trajectory. And this is a critical point because it highlights the importance of time horizon in analysis. And I fully agree with the assertion that the fundamental drivers of gold, including monetary instability and currency weakness, remain intact, and therefore the recent decline should be viewed in the context of external pressures rather than internal Arabic data, Arabic Deen, Arabic V. And when we factor in the selling activity by Russia and Turkey, it becomes even clearer that the price action is being influenced by factors Arabic-Ket, Arabic-Caliph, Arabic-Rod, Arabic-Jim, the traditional supply-demand framework. And this is where I would add that such events often create opportunities for informed investors because they temporarily distort Arabic-Caliph, Arabic-Lam, Arabic-Hamza-Tatalif, Arabic-Scene, Arabic-Teen, Arabic-Een, Arabic-Caliph, Arabic-Rod, away from intrinsic value. And those who can distinguish between structural changes and temporary disruptions are better positioned to capitalize on these movements. And ultimately, the key insight here is that while individual assets may experience short-term declines due to specific factors, the broader market dynamics continue to be shaped by larger forces that operate over longer time frames. Now, shifting our focus more directly to the precious metals themselves, particularly gold and silver, the analysis becomes increasingly technical and reveals layers of complexity that are often overlooked by casual observers. Because when we examine the price movements described, including gold's sharp rise followed by volatility and subsequent decline. It is essential to understand that such behavior is not uncommon in strong bull markets. And in fact, it is often a necessary process through which the market resets positioning, shakes out weak hands, and prepares for the next Arabic meme, Arabic rot, Arabic heat, Arabic clam, Arabic titmer Buddha of movement. And I agree with the perspective that when viewed on a longer time scale, these fluctuations appear as minor disruptions rather than a Hebrew shin Hebrew yod, Hebrew vav, Hebrew god, and trend. And this is a critical distinction because many investors make the mistake of extrapolating short-term movements into long-term conclusions, which can lead to poor decision-making. And when we incorporate the Arabic teen, Arabic noon, Arabic Saida, Arabic Rada forced selling by countries like Russia and Turkey, the picture becomes even clearer because these actions are driven by necessity rather than strategy, and therefore they do not reflect a Arabic Arabic crane, Arabic hit, Arabic rot in the fundamental value of gold. And the comparison to the UK's gold sales during the late 1990s and early 2000s is particularly relevant because it illustrates how even large-scale decisions by governments can be poorly timed when viewed in hindsight. Oh, and I would expand on this by noting that such Arabic alif, Arabic hamzatat alif, Arabic hate, Arabic dala, Arabic alif, Arabic thet often serve as contrarian indicators. Arabic lam, Arabic hamzat alif, Arabic noon, when major holders are forced to sell. It often signals that the market is closer to a bottom than a top, and this is not because the sellers are making irrational decisions, but because they are operating under constraints that prevent them from optimizing timing, and this creates opportunities for other participants who are not subject to the same pressures. And when we consider the idea that Russia and Turkey may be effectively competing to sell their gold at the best possible price, it introduces an interesting dynamic where short-term supply increases can temporarily suppress prices. But once this selling subsides, the market can Arabic bay, Arabic seen, Arabic rot, Arabic tetmer buta revert to its underlying trend. And this is where I would emphasize that the Arabic pa, Arabic aleph, Arabic farsi, Arabic aleph, Arabic noon of such selling is often more important than the selling itself because it marks the transition from a liquidity-driven market to one that is once again governed by fundamentals. And in the case of silver, the situation is even more compelling because while it is influenced by many of the same macroeconomic factors as gold, it also has a significant industrial component that adds an additional layer of demand. And this dual role makes silver particularly sensitive to both economic growth and monetary conditions. And I agree with the assessment that silver tends to follow gold during periods of decline, but it often outperforms during recoveries. Which is why many analysts view it as a leverage play on gold. And when we look at the current price levels mentioned, including gold around 4,591 and silver around 70, it is clear that despite recent declines, these metals are still trading at historically elevated levels, which reinforces the idea that the broader trend remains intact. And I would add that the volatility we are seeing is likely a reflection of the market Arabic clam, Arabic aleph, Arabic sheen, to reconcile short-term pressures with long-term expectations, and this process is rarely smooth. But it is essential for the Arabic Sada, Arabic key, Arabecta of the overall trend. And ultimately, the key takeaway from this section is that while price movements may appear chaotic in the short term, they often make sense when viewed in the context of larger forces and longer time frames. As we move into the deeper structural analysis of the silver market, this is where the discussion becomes particularly compelling because it highlights a critical imbalance that is not immediately visible through price alone. And this is the divergence between physical supply and paper claims. Equilibrium. And in my view, this creates a compelling long-term narrative for silver because it is supported by both structural demand growth and supply constraints, which together form the foundation for sustained upward pressure on prices finally